Good morning, everyone. Welcome to our bi-weekly Learn and Grow session. Today we have a very special guest, Steven Solinsky. I hope I said your name right. Welcome to our bi-weekly meetup. Steven, stage is all yours. Take a minute to introduce yourself and walk us through what you're going to share with us today.
Yeah, absolutely. Thank you. Do you mind if I share my screen? So I appreciate y'all having me out on this call. A little bit about me. My name is Steven Slowinski. I work at MW Law. I got into real estate initially because I grew up in kind of a, didn't know anything about finance, didn't know anything about making money or how to grow wealth or anything like that. Until I read Rich Dad Poor Dad, and I kind of lit that real estate fire in me. And so I was already on my way to law school. And so while I was in law school, I decided to give real estate a try. So I started wholesaling houses, flipping houses, worked with a great hard money lender out in Dayton, Ohio, and really kind of showed me the ropes. But I really wanted to figure out how to scale that business. And so I found out that there's this whole new world of capital raising and syndicating that I just had no idea about. Even though I had taken securities courses, I had taken business law. Nobody taught nobody tells you about how to actually raise capital for your deals. And so I started calling around different securities attorneys, and I, quite frankly, I couldn't afford the legal bill at the time. So I just decided to try and figure out how to learn that area of law myself. And fast forward 6 years later, I'm still trying to figure it out. There's so many nuances. There's so many things that change on a pretty consistent basis. So I actually fell in love with this space of creative deal structuring for real estate investors, for their funds, for raising capital. And pretty much that's been my focus my entire career. I'm going to skip through a lot of this stuff. I can always send this stuff I can send this presentation to you, but I just really want to go through the high level overview, just a quick 5-second overview of the securities laws, because I think that when you have a framework of how all the federal laws work, the structuring makes a lot more sense. I think how to act in different situations when it comes to capital raising will make a little bit more sense. And so I want to provide kind of this brief overview, which I'm sure a lot of you guys already know a lot of it. So, but just the Securities Act, the four main securities laws that we deal with. And I just realized that this slide is misnumbered, but that's okay. The securities laws the four main securities laws are the Securities Act, the Exchange Act, the ICA, Investment Company Act, and the Advisors Act. And so Securities Act basically says, hey, if you're going to be raising money from passive investors, you have to register that as a security with the SEC, basically an IPO, really expensive, or you have to find an exemption. The main exemption that everybody uses is Reg D, 506B or 506C. If you guys have been in this capital raising space for a little bit, you're probably familiar with those requirements. Once I send this out, you'll have it kind of goes through those requirements as well, but I just want to keep this high level. So there are other exemptions, but Reg D is the main one used among especially real estate investors. Securities and Exchange Act basically says that if you are going to be raising capital, you can't be compensated for raising capital unless you're either a registered broker dealer, which again takes a lot of time, a lot of energy, a lot of expenses, and there's ongoing reporting, etc. Or you're an associated person of the issuer. And to be considered an associated person of the issuer, you can't take compensation for raising capital, but you can be compensated for providing services, meaningful services to the fund that you're raising capital for. So that's the Securities and Exchange Act. Investment Company Act basically says, hey, if you're investing in the securities of others, in other words, if you're buying shares of a different company and that's your business, then you have to register as an investment company unless there's an exemption. The four main exemptions under the Investment Company Act are one that I call the real estate exemption, which is the 3C5. basically says if you're investing in real estate, real estate backed assets or loans, if you're investing directly in real estate, if you're investing directly in real estate, or you have the same benefits as a direct investment in real estate, and that's important, as we'll bring up later. You can rely on 3C5, which doesn't have any limits on the investors you raise, doesn't have any additional requirements to meet. So 3C5 is a really powerful exemption if you're going to be considered potentially an investment company. The other ones are 3C1, which limits you to 100 beneficial owners, less, basically fewer than 100 investors. It also 3C7, which you have to have, you can only take on qualified purchasers, which are investors who are 5 million, have 5 million in net worth or more. Or 3C9, which is what I call the oil and gas exemption, which is similar to the real estate exemption. So those are the 4 big ones that we deal with when working with the Investment Company Act. Then the Investment Advisor Act. I can spend a whole day on the Investment Advisor Act, but I'm going to try, well, not a whole day, but it's certainly another hour. So I'm going to try and break it down as quickly as possible. Essentially, there are 2 levels to the Investment Advisor Act. In all these other three laws, you don't have the SEC, or excuse me, the state law or federal law preempts state law. In other words, I don't have to look at the state law exemptions. I can just rely on federal exemptions. Investment Advisor Act actually doesn't do that. It says, hey, even if you find an exemption under the Investment Advisor Act, then you still have to look at state law. So Investment Advisor Act says if you're being compensated for providing investment advice, you either have to register as an investment advisor or find an exemption. Right, the exemption in federal law is pretty easy. Just have less than 150 million in assets under management, and you have to be an advisor to either a 3C1 or 3C7 fund. Notice it's not a 3C5 fund, which means that if you're relying on 3C5, you typically don't have to worry about any additional regulatory meeting any regulatory requirements under the Advisor Act. But if you're a 3C1 fund, if you're a 3C7 fund, you're going to have to you'll have to find that exemption on the private fund advisor or private fund advisor exemption. If you meet those requirements, then you go to the state. Then you have to look at the state level requirements, and those states have varying requirements of how to either be exempt or how to register. Again, I won't get into all of that because we want to get into the fun stuff, which is the deal structuring. There are, I pretty much describe everything as funds. I know in the real estate world, people consider syndications as a separate thing from, say, funds. So I often have to clarify that with clients. A syndication is basically an identified asset fund versus a blind pool fund, where people are trusting you as the manager to find the best deals and to have this good investment thesis, investment strategy, et cetera, et cetera. Within the blind pool world, there's also a ton of other, there's a lot of different ways that you can structure a blind pool fund, right? It could be open-ended, close-ended, it could be an equity fund, debt fund, et cetera. And so there's these different type of blind pool funds. But generally and again, I'll send all these, this slide over to you guys so you don't have to worry about missing anything too crazy. I want to get into the fund structure, and what I want to do is I want to kind of show how we structure it based off of the securities laws that we just talked about. So this is a typical identified asset fund, a syndication, where we have the asset that we've identified. We're going to go tell the investors, hey, we're going to purchase this asset or maybe these assets, and this is how the money's getting spent. This is how we're going to upgrade it, increase it, develop it, and provide returns. We're going to hold it for X number of years. It's very beneficial, for it's very beneficial for investors because they get to see and evaluate the deal itself before, rather than just blindly trusting the fund manager. So it's very beneficial for them. The problem is, let me get to, I'll explain these other components. So you have the asset that you've identified. Typically, we recommend forming an SPV, special holding vehicle or special holding entity that holds the asset. And there's different reasons why, but especially nowadays, lenders are getting a lot more strict on lending requirements, and they the SPVs just provide a more streamlined way to work with lenders rather than digging into the fund, because the fund documents are typically more complex. They have things that lenders don't always like. And so we don't always want the lenders to be digging through the fund's operating agreement, because there's a lot of things in that fund operating agreement that allows you to operate as a fund manager. For example, side letters and things like that some lenders don't like. And so we put it into an SPV. There's some other, asset protection reasons, but I've been recommending more syndications use SPVs lately because of lender requirements. So you have this fund entity that has separate classes of members. You have investor members and you have sponsor members, or what I call sponsor members. And typically in our documents, we refer to them as Class A members, the investors, Class B members, the sponsor members. But you can honestly have as many classes as you want. You can structure them as however you want. So you can have different types of investor classes with that you can give different voting rights to, different requirements, etc. But this is the basic structure. And then, of course, we have a management entity that oversees this whole thing. How we structure it is we make a manager managed, or we make the fund a manager managed LLC. So the manager stays outside of the entity. There's a few reasons why we do it that way, as opposed to making it a manager managed or a member managed entity. But again, I'll go ahead and skip that reasoning for this in this presentation. So this is kind of how all the rules that we just talked about kind of fit into this structure, right? So we have the Securities Act that basically regulates the transaction between the investors and the issuer, the fund. We have the Investment Company Act that regulates the fund itself. You have the Exchange Act that essentially regulates the actions of the sponsors or the members of the manager. And then you have the Investment Advisor Act that, if it applies, would regulate the management entity. And so I have, again, I'll send these slides, and you can see kind of how these different components work. If you're doing a real estate deal, again, you can rely on 3C5 under this, under the Investment Company Act. The Securities Act and the Exchange Act are going to pretty much apply the same no matter how we structure the deal. But really, the main differences in these kind of structures is the Investment Company Act and the Investment Advisor Act. In a real estate deal where you're buying the asset directly, or at least through a wholly owned subsidiary, the Investment Company Act and the Investment Advisor Act don't really apply. Some people still say that 3C5 is required in a direct asset purchase, but the SEC has actually said that real estate is not a security. Therefore, the Investment Company Act, it's actually an exclusion rather than an exemption. However, if you need to rely on an exemption for whatever reason, let's say you're going to put 20% of your assets into another deal or something like that, that's not real estate, then 3C5 is important, or you'll rely on 3C5.
Can I ask you one question here?
Yes, ma'am. Absolutely.
In 3C5, so you said some are not required. So are we required to have this ERA filing for this one? And depending on what state you operate in when you're running a 3C5 fund?
You don't. Nope. And that's because, and actually I have a slide on it.
Because I have a 3C5 fund, and that's when I'm
Yeah.
struggling with a little bit to figure out, do I need it? Some people say yes, some people say no.
So you don't. And the reason why, and there are some reasons why people would recommend it, and I definitely get those reasons. But in order for the so there's two pieces to that. First, the Investment Company Act excludes, not exempts, but excludes investments into real estate. So if you're saying, hey, this is a company that is investing only in real estate assets, the SEC says, hey, real estate is not a security, therefore your business is not investing in securities, therefore it's not an investment company. So really 3C5 doesn't even apply. You're excluded from that, even from the ICA or the IAA applying to you. But the reason why we say, hey, the 3C5, you can rely on 3C5 if you need to, is because let's say you're doing a blind pool fund and you're purchasing, you put 80% of your assets, or 80% of your assets are real estate assets that you physically own. But let's say that you also have 20% of your assets that you want to invest in, let's say another syndicator's deal. Well, now you're going to have to rely on 3C5. But as long as you rely on 3C5, it doesn't implicate the Investment Advisor Act, which is where the ERA comes from. It doesn't implicate the Investment Advisor Act because the Investment Advisor Act, or the exempt reporting advisor, is only applicable to 3C1 and 3C7 funds. So, I mean, literally the rules exclude 3C5 funds from being considered private funds. There is one exception though, and this is where the state, and this is actually why I'm asked what state you're in, or this is why it's helpful to know what state you're in. In Arizona, it's the one state that I know of that actually includes 3C5 in its definition of a private fund. So let me see if I can get to the slide. Hopefully this will be a little bit easier. So the go back up here. Investment advice. Yeah. So with fund managers, you're considered fund managers may be considered investment advisors if they advise a private fund. But the SEC defines a private fund as only 3C1 or 3C7 funds. A 3C5 fund is not a private fund. So again, when you go at the federal level, typically if you're doing a 3C5, you don't have to worry about the Investment Advisor Act. But
so 3C5 is a real estate fund, right? But 20%, mine is a customizable fund that I did through Avestor. It's a 3C5 real estate fund. But again, at the same time, you can invest in other deals, right? You could be like co-GP with others, and you do not have to have on the acquisition side 100% yourself. And beside that, you're allowed to put 20% other than real estate, right? And still, you don't have to do any ERA or anything like that in California.
Correct. In California, yeah. Again, Arizona, you would, unfortunately, but that's the only state that I know of that includes 3C5 in the definition of a private fund.
Perfect. Thank you so much.
Yeah. But again, it's very it's very important to note that again, you have to have 80% of your assets in real estate or real estate backed assets that you physically control. The other 20% you can put into other things. I've had actually had a client do 20% into crypto funds. I don't recommend that. I think assets typically should be separate, but it's possible. So, but okay, so that is. Let me get back to my spot.
Sorry, didn't mean to derail it. So
no, that's great. And honestly, if anybody has any questions while I'm going, I know I can talk really fast. So please stop me, ask questions. I'm definitely happy to address them as we go. This is the blind pool model. Again, it's similar to the syndication or the identified asset model. Same rules apply in the exact same way. The only difference is that in a blind pool fund, you have everything gets commingled. So profits, losses, assets, liabilities, everything gets commingled and then shared across basically the whole portfolio. The investors get to share in the profits and losses of the entire portfolio that you invest in. As I was mentioning in this syndication or the identified asset model, one of the downsides of that is that investors or syndicators often don't start raising capital or even getting capital commitments until they've identified a deal. But oftentimes when you have closing deadlines of 30, 60 days, raising $5, $10, $15 million, even $20 million or whatever, can become very stressful. Already you're stressed out because the closing is going to, you got a lot of lender requirements and broker requirements. You might be going back and forth with the seller. You have all these other things that you're doing in the deal. Plus now you have to raise capital and make sure you have that money coming in and investors are actually, paying, making their capital contributions. So it's an extreme, I work with a lot of serial syndicators and it's stressful every single time. At least from my perspective, it seems very stressful. So a lot of people move to the blind pool funds because that way it gives them, they can go and get capital commitments based on a thesis. So they'll say, hey, I believe in multifamily and these other real estate assets are great assets to invest in because of X, Y, and Z. Here's the criteria we're looking for. Here's why we have this criteria. And we're going to go out and find these deals based off this deal criteria. So that way you can get these capital commitments up front without, so you have the available capital when you go to purchase the assets. One couple downsides to fund is that you have first of all, especially if you're newer in the space, you may not have the track record to raise the capital in a blind pool fund. You may not have the following, et cetera. So it's not always right for everybody to start off with a blind pool fund. And the other problem is that depending on how big the fund is and how long you want to keep it open, the administrative burden can become very daunting. For example, if you're going to have an investor, if you're going to keep your offering open for, let's say, 2 years, let's say you have an investor come in year one, and then you have another investor come in year two, and then you make distributions in year three. How do you solve for the early stage investors versus the later stage investors, right? We have true up mechanisms. We have different ways that we can address that, certainly, but it adds a little bit of an administrative burden. The other thing is if you keep it open indefinitely, there's often exit requirement. You have to provide some sort of exit option for investors, and those typically, I call them redemption rights, or they might be called call options or put options. Excuse me, they'd be put options. People call them different things, but essentially it's the same thing, right? People come to you and say, "Hey, I want out of the fund. Here's my shares. Give me my, pay me for these shares, and I'll get out." And again, that whole process can be administratively burdensome. So funds are really good for having capital available, but there's pros and cons to that as well. Then of course we have debt funds, which are rely on pretty much all the same rules as the syndications and the blind pools. The one difference with the debt fund is that it has to rely on 3C5. And the majority of the loans have to be secured against real estate. Not all of them, but at least up to 80% of them. So debt funds are really debt funds again have the same pros and cons as blind pool funds. One thing that people like to do though with debt funds is usually they offer a preferred return. And for those of you not familiar with preferred returns, it's basically an interest rate on your money, but it's not a guaranteed interest rate. It's only available if there's cash to pay it, but that's essentially what a preferred return is. And so most people in debt, or a lot of people in debt funds, only offer a preferred return. So they're going to say, "Hey, we're going to offer loans at 9%, or an 18% interest rate, but we're going to give our investors a 10% pref or whatever it is, and then we're going to keep the difference." What makes that easy is that if you're going to keep these investments open long term, let's say it's an evergreen fund, it's a lot easier to calculate. It's a lot easier to from an administrative burden perspective. It's a lot easier to manage that, especially when investors are coming in and out, because all you have to do is pay them their accrued preferred return, and then redeem their shares, and they can get out. So debt funds are very popular to become evergreen funds, or to make an evergreen fund. Because of that aspect of just paying the preferred return.
Hey, just a quick question on that. Can you go back one slide?
Yep.
So a debt fund, you said, is always backed by real estate, at least in this terminology. Is that correct?
The majority of the loans should be backed by real estate.
All right. So what if, like, for example, I work for a company that they have a big portfolio of performing student debt, and they do a Reg D 5060 offering, promissory note offering to their investors. And I know that those are not backed by anything other than the portfolio. So how would that be classified? It's not a debt fund because debt fund has to be real estate backed.
A debt fund could be a 3C1 fund, but in order to rely on the real estate, the real estate exemption, it has to be backed by real estate. So a 3C1 fund would allow them to still invest in debt, but they could only take on 100 investors. Now, it does depend. I'd have to look at their documents and see if there's any other, if that debt is secured by anything else, and then we'd have to look at and see if the SEC has considered that to be equivalent to a real estate asset-backed loan, and they might still apply a 3C5 depending on how they classify the collateral. But typically, you could still do a debt fund under 3C1. Does that make sense? Does that answer your question?
Okay, so Jeff is asking about the new structure that we promised everybody, because I know that you've done some business with Rise 48. and we're comparing to like what Avestor has done a little bit. There's a new structure that you had kind of gone over with me a couple of weeks ago. Can you tell us a little bit about that? Do you have slides on that?
Well, we'll just jump down. So we do have more on the fund of funds, but we'll jump into this. So this is called the Flex Fund, and the idea here, as you can see here, it's structured very similarly to a syndication. And the reason why we do this is because we want to be able to provide complete separation between assets and liabilities. We want to make the administration a lot easier. We basically want these things to operate exactly like a syndication or a small blind pool fund, because you can make these classes into blind pool funds. So we created these classes to essentially act as their own investment vehicle. And so what we do is we create this overarching fund. We call it a flex fund. And then within this flex fund, we create these classes. These classes are different than the classes in a syndication. As I mentioned up here, you can have Class A members, Class B members, etc. Same concept, but a little bit different. So these classes in the flex fund act as their own investment vehicle. So think of it like, again, a syndication with a fund overlay. And so you have complete separation of assets, liabilities. You have easier administrative burden, and I'll talk about a little bit about the customizable funds versus this in a little bit. But within this class, you can have multiple subclasses, and those subclasses are the investors, the sponsors. You can have multiple subclasses of multiple investor subclasses. So you can have A1, A2, A3, etc. Offer them different terms, offer them different voting rights, offer them whatever. You can have your own. You can charge your own fees. You can create your own waterfall. Everything that you can do in a syndication or a small blind pool fund, you can do in this flex fund. The benefit is that we don't have to create a new PPM operating agreement subscription every time because because the flex fund already essentially we basically have this master operating agreement, master PPM, and then we're able to create short form addendums to the operating agreement and PPM with the specific deal points. So rather than creating a whole new operating agreement, we just have to say, hey, here's the waterfall, here's the fees, maybe here's some additional voting rights, and that's going to be applicable to just this class.
All right, so just to clarify, if I'm raising for one specific sponsor that launches a deal every couple of months, I don't need to create a new PPM in this structure every time that there's a new deal that I'm raising for? How does that work?
Yeah. So the reason why we're able to do that, if you think about a let's go to a blind pool fund or any kind of fund, you're creating a new entity every time, and a new entity is, think of it like its own person. I mean, by statute, by law, it is its own person. Therefore, it needs its own governing documents. It needs its own PPM. It's a completely different issuer. So you need all this new stuff because statutorily, it is a different person. In a flex fund, statutorily, because it is a single entity. So I'll get back to it. In a flex fund, this is the larger flex fund example. This entity itself is the statutory person, so it has its own governing documents. But these classes are part of this statutory person, so you don't have to create a new operating agreement, a new PPM, etc., because it's part of the same person, essentially. And so we're able to, but we do want to make sure that the assets and liabilities and everything else is completely separate. Because let's say you have an investor who wants to invest in this class, who wants to invest in this deal, but doesn't want to invest in this deal. One of the biggest problems is, well, what if this asset gets foreclosed on, right? If all the deals are commingled and there's no protection between these classes, if this asset doesn't cover that foreclosure, the foreclosure expenses, then that lender can reach into this fund and basically affect they can potentially force the foreclosure on this asset too. And there's no protection there's no protection for investors who didn't want to invest in this deal in the first place. So we still want to treat each of these classes like a separate business, but we don't want to necessarily create a new statutory person because that creates additional expenses, additional administrative burden, etc. Does that make sense?
So, and then I'm not too familiar with what a investor does. Is this what they're doing as well, or no?
So they do
Yes.
something, yeah. So actually, and Vinky, you might be able to answer this better because you actually have an investor fund. I have set up a couple investor funds. So I'm gonna explain it from my perspective, oh yeah, I see Samir, you got your hand up.
Yeah, can I say something, Samir, before
Yeah.
you ask your question? Thanks, Stephen, for explaining this very well. But you were talking about the liabilities. That's the portion I wanted to ask your question. How do you segregate each deal? When you say different classes, I'm assuming you're referring to different deals, or different investment deals that you're bringing into the fund. So how do you segregate that there's no liability issues? That's what the only thing haunts me all the time, and I ask this question to everybody whosoever I meet who's talking about 3C5. What if it's a customizable fund? What if there's something goes wrong? How do I protect all the investors who are not part of a certain deal, which is going downhill or something?
Yeah, so the simple answer is that these classes are treated, and we have a ton of language, both within the operating agreement that I put in. I mean, not to brag too hard, but when I was drafting the latest version of the documents, I put in almost 100+ hours a week for a few weeks just to draft this language, because it was very important for me to make sure that the language was very strict and very clear about how these assets, liabilities, everything else is separated. What we do is essentially we treat each class like a series by contract. So I'm sure you guys are familiar with series up, and I don't want to assume, but assuming you guys are familiar with series LLCs, a series LLC is again a series by statute, but not every state recognizes statutory series LLCs. Florida, for example, wouldn't recognize a Delaware statutory series, et cetera, et cetera. So we have that problem. And actually, initially, we had considered doing a series offering because the SEC has approved series LLCs to be used as a single offering, just like a class. But the problem is that in real estate, when we're dealing with multi-state lenders, they won't always recognize series LLCs. So we didn't want to create two layers of LLCs, because we still use this SPV that we get the loan through. We can also help separate out assets and liabilities. But using a series, we'd literally have to create a series LLC down here and then a regular SPV up here. So we decided to go with the class, and basically it's called a series by contract. So we treat each of these classes as a series, just like a series LLC, but it's a series by contract versus a series by statute.
Can I ask them,
Sure.
as far as us investing through the fund-to-fund model as an LP, aren't we by that setup protected, and the only risk being the limit of our investment? Isn't that the definition of an LP investor? My concern, first, that's the one question. The other one is, I could understand within a fund, if somebody within the fund wanted to sue for some reason, then everybody within the fund could have liability. But can you address the part that you were discussing as far as it coming from the asset? My understanding, we shouldn't have any liability beyond what we invested.
Yeah, correct. Yeah. So you're as an LP, you're absolutely right. You won't have personal liability. However, if in a customizable fund, for example, all right, let's go.
But the fund is the investor.
Right. But the asset, but think about the lender, right? The lender is going to have collateral on this asset. And if a business owns multiple assets, then let's say the collateral is not sufficient to pay that lender back, that lender can reach into the business and take other assets. They can foreclose on other assets. If you're an investor who didn't want to invest in this deal in the first place, why are you getting affected? Again, you won't personally get affected, but your returns are going to get affected because now the lender can reach into these other assets and can foreclose on these other assets. So now you didn't invest in this deal. You're not going to get personal liability. Like, the lender is not going to come after you personally. Absolutely not. Well, I can't say absolutely not, but most likely not. But they are going to affect the deal that you invested in, right?
Yeah, the deal invested in, but not anything else in the fund.
No, they can invest. I mean, if this, and that it's another reason why we have SPVs. But there could be times where if this asset is not sufficient to cover a loan obligation, the lender who lended on this asset could still reach into the fund and potentially affect other assets in order to satisfy previous obligations. So in this fund model, we segregate the assets and liabilities through these classes rather than have it commingled into a single fund.
Yeah, so but I wanted to ask you a very straightforward question here. So how this structure is different than the fund that we're trying to do on Avestor? Because you're talking about the classes and you're talking about series LLCs. This came to my mind too a long time back, they're creating a like LLC for each deal that you're bringing in. But then it's just like, how are you going to manage that? Maybe at the fund level, you have LLC, then you're creating LLC every time. So you need the attorney intervention every time when you're trying to do that, because that way you're segregating each asset and you're protecting each asset versus having everything under one umbrella. And there's always going to be issue with something goes wrong, the fund is going to get sued. And that's what the issue I see with the fund. And thanks for addressing that. If you can shed some light how you're doing that and just being strategic about that.
No,
so-
this would also be true on a blind fund, though, correct?
Yeah,
Not just the flex fund.
Yeah.
Yes.
So yeah, absolutely. So on a blind pool, the nice thing is that, and let me back up. Technology's really empowered a lot of these new fund structures. So I mean, you look at Avestor, you look at this flex fund. The reason why we're able to do these kind of things now versus say 5-10 years ago is because of technology. It's become a lot cheaper, a lot easier to implement. And so that technology has allowed us to create these more innovative structures. This structure specifically, actually, I read about back. I read a no action letter by the SEC from back in the 2000s, basically discussing this structure using a C corp, and they called it tracking stock versus classes, but same concept. So this has been around for at least 20 plus years, but it was being used by much bigger companies that had that were a lot of much bigger companies, but they were paying a lot of money in admin fees, they were paying a lot of money in legal fees, and all this other stuff. But technology's really allowed us to implement these kind of structures to keep costs low. So for example, we work with a lot of the investor portals, and they have how the normal investor portals works, Syndication Pro, Cashflow, InvestNext. They each create a new you create a new portal every time you're doing a new deal. Let's say you're just doing syndications. Let's say we're just doing syndications, right? So you'll go in your investor portal, you'll say, hey, I'm raising money for this asset. I'm raising 5 million. Here's my investor member. Here's what I'm offering to my investor members. Here's what I'm offering or here's what the sponsor members are getting, et cetera, et cetera. So those investor portals help you help keep track of all your investors. They help keep your cap table managed. They help with the allocation of profits and losses based on the investors. They can even do it based off timing of investors and how much, et cetera. So that technology allows you to segregate all your different deals. Even if you're doing serial syndications where you're doing fund 1, fund 2, fund 3, and you're just doing that one after the other, these portals still help you keep all of that organized. The flex fund essentially is built off that same concept. Excuse me, let me get back to it. The flex fund is based off that same concept. So again, let's remove that fund overlay, and you can see that these are exactly just like syndications, right? So you can you go into a portal, whatever your investor portal is, and you still create this deal just the same way that you would a normal syndication, and when you're creating a new class, you do it the exact same way in that new portal. So it's managed pretty much the exact same way as a syndication, but we have this fund overlay that allows us to not have to create new documents every time. Does that make sense? Does that answer your questions?
So Stephen had a question about that, which is so it sounds like you're saying that in the past, right? Let's say if you didn't know, if you didn't have your list of assets pre-identified, you'd go for a blind fund, whereas nowadays you could go for a flex fund just because, which is probably superior because technology has made it cheaper, right? Is that right?
Yeah, exactly. And through this, and by the way, you can still create, you can create these classes. We had one client who did an evergreen fund, or he treated one class as an evergreen fund that invested into another evergreen fund, right? And so this flex fund is meant to be evergreen, so it's not meant to close. And for us, anytime the law changes or anytime we have to update our docs, we provide those amendments and those addendums to the PPM as needed. But you don't have to recreate new ones. But this was meant to be an evergreen structure, which means you don't ever have to close this down. So if you think about it, that client that we worked for, we did an evergreen fund at this level. This was an evergreen fund, and then they invested in another evergreen fund, right? So that's, I mean, it really is. You can do pretty much everything you want to within those classes, just like you would a regular fund. But it is, again, it just streamlines the legal process because you don't have to go through all the hoops like you did, before.
So I'm looking at this model that you have created. So you have this flex fund sitting in the middle, kind of, you say it's the overlay. That's the terminology you've been using. And then you have asset one and asset two, like SPV1, SPV2, that's sitting on the top and they're plugging into fund. I'm not sure if I understood the structure.
Oh yeah, so in this, let's remove this what I'm calling the fund overlay. So let's just assume this is an LLC, right? Instead of class 123 Main Street, let's call it 123 Main Street LLC. Just like in a syndication, we have this SPV, and that SPV holds the asset. So yeah, I mean that's pretty much and then you'd create another class, and it would do basically the same thing. We'd set up the SPV, it would hold the asset, et cetera, et cetera. Or if it's a blind pool fund, it might hold multiple assets. We might have multiple SPVs. However we want to structure that, we can. If you're looking at like a fund to fund, though, here's a flex fund to fund. In this case, here's how that would look, and hopefully this isn't too confusing. But the flex fund essentially, well, actually, let me go to a normal first to a basic fund to fund model. So here's a basic fund to fund model where you're the fund to fund right here, and you're plugging in as an LP into this other, what we call a portfolio or target company. Just call it target company for this presentation. So you're plugging into this target company as an LP, and here's the fund to funds. So it's the exact same in the flex fund, and then of course within your fund to fund, you can have your investor members, your sponsor members, your manager, just like a normal fund. The only difference being that you're investing in the securities of others rather than the asset directly. In a flex fund to funds, it's the exact same. It's the exact same structure. And again, if you just remove this fund overlay and assume that this is an LLC, you'll notice that it's the exact same structure as your typical fund to fund. Sorry, keep losing it. So it's set up the exact same way, but now we just have this fund overlay. So again, we don't have to create new operating agreements, new PPMs, et cetera, every single time. And so again, hopefully to promote efficiency on the legal front. Did that answer your question?
Yes, it did.
So a lot of it has to do with the again, the language and the restrictions that we put around these kind of things. So again, if you ever read my operating agreement and even what we call the class packages within each class, there's provision after provision explaining how these things should be separate. But then there's also I also provide a lot of guidance for how to keep them separate. So separate bank accounts. One thing that my clients do is when you open up a fund bank account to take care of general fund fund expenses, and I explain that how to do all that in the operating agreement. So you have the fund that deals with, or you have a main fund operating account that takes care of all fund expenses. Then you can create other accounts specific for that class. Most banks allow you to nickname your accounts. So you can just nickname it whatever the class that it's associated with. So you can keep track of what accounts are tied to what, to which class. So that's one way to make sure that it's separate, right? There's the legal conceptual piece there's the practical piece. And then there's the accounting mechanisms that we also build in. Again, from a it's sort of a legal concept, but also there's a practical implication. How we keep everything separate within a class is we create these things. Again, it's a legal concept, but we basically create these what we call class capital accounts. Think of them like a member capital account if you guys are familiar with fund admin stuff. So it's kind of like a member account, but it's an account, it's a capital account for the class. Think of it like a balance sheet. So all the profits, losses, etc., go to that class's balance sheet rather than getting segregated, rather than commingling all the assets, liabilities of the fund. And that's also something a little bit different than what a investor does. So we have these essentially balance sheets that the profits, losses, etc., go on, and from those balance sheets, it gets everything gets allocated to the members of that class. So that's also why, like in a fund of funds, you notice I don't have an extra SPV here, because as long as target companies provide you with the allocations, you can target that allocation to the class capital account, and then from that class capital account distribute it to the members of that class. If that sounds confusing, don't worry. Your CPA. I've talked to several CPAs. Worked with several CPAs, several fund admins. We actually signed a fund admin agreement recently. So we have, so we can always help you out with that if it sounds confusing. But yeah.
And
No, I think
Stephen,
this is really good stuff.
Oh,
Go ahead.
yes, sir.
Sorry.
yeah, you're saying that even so the same protections you'd get, by sort of separating the classes out, you would still get through the structure, even though you're still part of the same LLC. Is that right?
Yeah. And again, that it's just because we've created these classes as, again, series by contract versus series by statute, but it acts the exact same way as a series LLC.
So cost-wise, what kind of a difference are we looking at?
So something like this is a little bit, I'll just be honest, it's a little bit more expensive than an A-vestor model. But the goal, but one of the things that we like to do is so one, it does cost a little bit more than an A-vestor model. I apologize, I don't feel extremely comfortable sharing the prices on camera like this, but I would be happy to do one-on-one consults and give pricing. But it is more expensive than the investor model. And then for each class, we do charge an additional, I don't mind saying this because it's, but it's $5,000 per class package, or per class. The reason why we do this, and again, it's a little bit different than A-vestor. So I know A-vestor, they say, hey, once you have a deal, you'll create basically they'll have the fund manager create their own disclosure deck and all that other stuff where they talk about the fees and how everything's structured. But because these classes are again legal, that we have to make it legally binding, and we have to make sure that these protection mechanisms are in place. Our documents are drafted in such a way to ensure that those protection mechanisms are applied for every class. So we do charge a little bit extra for each class. But if you look at if you think about the price of a syndication, typically, most of my competitors charge between anywhere, on the low end, 12,000, 13,000, on the high end, 20,000 for just a syndication. So when you're looking at that and you're looking at a 5K, package price, my sincere hope is that it does lower the legal fees over the long period.
When I spoke with you a couple of weeks ago, I thought we discussed some model that was cheaper, that was less expensive than A-vestor or what Rise 48 is doing with their fundamentals program.
I don't recall it cheaper. I mean, other than a syndication, like a standard syndication, which I still do. Obviously, I can still do standard syndications and standard blind pool funds. Those would be cheaper than the flex fund. But and you could talk to Rise. I know they have some special promotions with the flex fund and their program as well. But again, that's sort of kind of a one-on-one conversation that we can have.
one more question I wanted to ask you. So like you say, when you do the segregation, you do it at the PPM level. So I think we can take all that, verbiage or whatever is written in the PPM portion of it, and we can always put it at the deal level too, in the deal disclosure level, right? To kind of emphasize that, okay, this is for this deal only, and nobody's gonna go outside of this thing, period, right?
Yeah, exactly. Yeah, so we make we do all deal level disclosures in what we call the class package. We do all what we call the class rules, which is the addendum to the operating agreement with all the specific deal points. So yeah, we create all that for you in the class for each class that you create.
All right, from one last question from the sponsor perspective that's looking out into the future. We're really excited that, groups like A-Vestor and some of these other very creative fund structures have been coming out. Do you foresee that this is going to get less expensive as new competitors and come in that can offer administration and, all-inclusive syndicator portal fund launches? As this goes into the future, what do you see? Like, is it going to be better? Is it more competitive, more creative products?
Yeah, so I'll tell you a little bit. So the answer is yes. I do believe everything's going to get a little bit, lower barriers to entry. And as an attorney, obviously, like I look at the prices of my competitors, and they're all pushing their prices up. And one thing that I do see, I think that a lot of this technology is going to push prices down. Institutional level, deal, like really a lot of this stuff is being driven still by institutional level fund managers. But I think as we see more newer emerging fund managers come into this space, they're going to be looking at more creative opportunities, creative ways to reduce fees on the startup. And so I think technology is going to drive that. I think AI is going to drive that. I actually heavily use technology and AI in my practice to help reduce costs, produce faster turnaround times. And so one thing that I'm personally doing, I'm exploring different pricing models to be able to lower my fees without hurting my bottom line, because I'm at the end of the day, I'm still a business owner. I still have financial goals that I'm trying to hit, but I also see this as being a way to, the more technology that can be infused into these legal processes and the accounting processes and everything else, I think the lower the fees are going to be overall for new fund managers. And I think for me right now, I'm exploring different pricing models to still help reduce the cost, but also not hurt my bottom line. So I'm exploring that actively right now. But yeah, the answer is yes. I do see it.
Bottom line, at the end of the day, if you're a fund manager that's raising for multiple deals with multiple sponsors in multiple states, and they're all real estate, this particular model is your most recommended model, or did we miss anything there?
Yeah, no, I think, I tried to be as little as a salesperson as I can be. Because I do take pride in myself as a professional attorney, and so I always want to give you the best advice for your specific situation. So I can't say the flex fund is the best for everybody. I can't even say the customizable fund is best for everybody. I can't say that is the best for everybody. I think it can be good for some people in the right circumstances, and I would love to talk through those circumstances and see if it's right. But there's ways that we can also help reduce cost using a typical syndication model, right? Like we can set up the systems and processes to help reduce that. So I want to say that there's all kinds of ways that we could structure deals, and there's all kinds of ways that we can add value here. And it could be I don't think it's a one size fits all, but it's always helpful to have more options so you can explore what is best for you.
Well done. All right, we're a little bit past the end of the hour.
Yeah. I gotta jump. I got another call, but I'll share this slide deck, and you guys will have my information. So if you ever want to schedule calls, I'll be available.
Awesome. Appreciate you, Stephen.
Yeah,
thank you so much, Mickey, for running the show.
It was really good, Stephen. Can we have you back one more time, please? I think this wasn't enough. I think it was too short.
Yeah, absolutely. Absolutely. Sounds good. Yeah, I appreciate it.
Thank you so much.